This is the Economic Club of Florida, a distinguished platform for discussion of the major national issues of the day. On today's program, Jackie Benson, Vice President and Economist with Wells Fargo's Corporate and Investment Bank, with an assessment of the U.S. and Florida economies for the rest of 2025 into 2026.
A main driver of economic resilience is population growth. So historically speaking, population growth and economic growth are very closely tied. And in 2024, Florida was the fastest growing state in the nation. One thing to keep an eye on is a potential slowdown in immigration flows, and that will likely drag on population growth over the next couple of years.
Good day and welcome to the 592nd in our series of distinguished speaker programs. I'm Harvey Bennett for the Economic Club of Florida. Florida's economy has consistently been in the news over the last few years, especially in comparison to other states, with at times the largest growth in GDP, largest growth in employment, lowest unemployment, biggest in-migration of residents from other states, only accelerated by the COVID-19 pandemic, most popular place to retire, among the lowest taxed states. The list goes on. One of the latest headlines, that Florida leads the nation in international home sales. It seems everyone wants a piece of the Florida action. But what's the future look like? We're delighted to have with us today Jackie Benson to answer that question. She is a vice president and economist with Wells Fargo's Corporate and Investment Bank. Among her other duties, she's the author of Wells Fargo's regular economic indicators reports. Jackie, welcome.
Thank you, Harvey. It's a pleasure to be here.
Please tell us some of the topics and issues you're going to touch on in your upcoming presentation to the Economic Club of Florida.
What I like to do is start by laying the landscape of what's going on in the macro economy and what headwinds might be coming down the pike. The elephant in the room today is tariffs, both the uncertainty in ongoing tariff negotiations and the actual economic implications of higher taxes on imports. And then I'll drill down into Florida, talk about why the Sunshine State is well positioned to navigate these turbulent waters, and also talk about some of the sectors that aren't doing so well recently. You mentioned international home sales. Well, if you look domestically or kind of at overall home prices, there is some weakness in the Florida home market. That's because of headwinds like high mortgage rates and home insurance costs. So I'll get into all of that.
Okay, and you mentioned the home sales. Real estate obviously is a big driver of Florida's economy. We've got so many people moving here. Mm-hmm. It seems like we did suffer a big hit during the foreclosure crisis of 2009, and I know that's been a topic in the news lately, is foreclosures.
Yeah, that is true. So if you look historically, Florida's economy has grown faster than the national economy for most years on record, with the only exception being the years surrounding the housing bust. So real estate is a very important sector to the state.
Well, it certainly seems that no matter what's happened to the U.S. economy over the past 10 to 20 years, Florida has managed to remain resilient and moving in a positive direction. Why is that? What is it about Florida? Besides the sunshine, the great weather,
the
nice
sunshine
people.
is great, and as you mentioned, more lenient tax and regulatory environment does encourage businesses to open up shop here. I would say a main driver of economic resilience is population growth. So historically speaking, population growth and economic growth are very closely tied. And in 2024, Florida was the fastest growing state in the nation.
Okay, so we brought in more people than other states.
Yeah, so Washington, D.C. technically had higher population growth than Florida, but among just states, Florida was the fastest growing population.
Sure, the more people, the more business activity, the more taxes collected, the more revenue,
exactly,
the more you can support an economy.
And the more labor supply available for businesses to grow.
And that's a key. I know you mentioned in our pre-talk, that's a component of what you're going to talk about today is labor.
Yes, labor is a key indicator when I stack up states or cities against one another to see where are the stronger locations in the country. when it comes to Florida, there is a challenge brewing in the form of demographics and an aging population kind of weighing on that supply of labor, and that's offset by population growth. So one thing to keep an eye on is a potential slowdown in immigration flows, and that will likely drag on population growth over the next couple of years.
And that seems like it's always been a challenge for Florida. We're a high retiree state, but yet we need an active workforce, a younger workforce for the service industry to support those year-long residents and permanent residents. Yeah. You're based in Charlotte with Wells Fargo, but you're originally from Florida. Where'd you grow up?
I am. I grew up in Tarpon Springs, Florida. It's right on the West Coast, west of Tampa, and it's known for its Greek population. So about 80% of the folks there, myself included, are Greek.
Yes, and sponges.
And sponges. We have the sponge stocks, yes.
That's terrific. Well, welcome back to Florida.
Thank you so much.
Your role with Wells Fargo as an economist, it must put you in the middle of a lot of interesting and enlightening data. What topics and areas do you specifically cover in your role with Wells Fargo?
So I cover regional economies, both at the state level and more localized, and then also real estate, both residential real estate and commercial real estate.
Right. And your indicator report, is that quarterly?
So we write a bunch of indicator reports. We'll write up a little note on housing starts, construction spending, and even state employment. So that comes out tomorrow. And we'll write a quarterly chart book of the most updated state employment trends.
Jackie Benson, Vice President and Economist with Wells Fargo's Corporate and Investment Bank. A pleasure, and thank you. We're looking forward to hearing your upcoming presentation on the U.S. and Florida Economic Outlook.
Thank you.
Now, here's board member and former club chairman Lo Bilby, principal shareholder for the Greenberg Traurig Law Firm, with our formal introduction.
So I have the pleasure today to introduce our speaker, Ms. Jackie Benson. As you saw from our Economic Club of Florida Echo newsletter, Ms. Benson is an economist, and we are the Economic Club. Jackie is vice president and an economist with Wells Fargo's Corporate and Investment Bank. She is based in Charlotte, North Carolina, where I trust the temperature is cooler than it is here today. She covers the U.S. macroeconomy, the big picture, including residential housing, commercial real estate, construction, and regional economies. Before joining Wells Fargo, Jackie served as a senior economist at the U.S. Senate Joint Economic Committee in Washington, D.C., and before that, she was a policy director at the American Action Forum, a policy research organization, again in Washington, D.C., focused on immigration and trade policy. They're probably more active lately. She holds a master's in science degree in applied economics from Johns Hopkins University. Her concentration at Johns Hopkins was in quantitative methods with courses in machine learning, macroeconomic forecasting, computable general equilibrium modeling. That is abbreviated CGE, something I did not know, of course, and microeconomics. Johns Hopkins, I might add, and founded in 1878 as America's first research university, and its Department of Economics is a world leader in economic theory and empirical analysis. She holds both a Bachelor of Science degree in economics and a Bachelor of Arts degree in political science from that other university further south, the University of Florida. Go Gators. And the President's tie is indicative of the Gators. Please give a warm Economic Club welcome to Ms. Jackie Benson.
Thank you very much. And I appreciate the Gator shout-outs. I see you guys. So today I am going to deliver Wells Fargo's economic outlook. I'm going to start setting the stage at the macro level, and then I'll drill down into the state of Florida. So to begin, let's just set the stage how the economy has been doing. Y'all are probably familiar. What we're looking at is real GDP growth. That's the sum of all goods and services produced in the economy domestically. GDP contracted 0.5 percentage point in the first quarter. Now, if you dig into what drove that contraction, which you can see on the slide on the left, it was really a drag from trade. So in Q1, what we saw is businesses rush to get ahead of the incoming tariffs that were to be applied in April 2nd. And that import spike drove down the headline GDP number. So generally speaking, imports are not counted in GDP. So the act of buying a foreign good in itself is not a drag on the economy. But the act of buying a foreign good instead of a domestically purchased good does reduce the overall level of economic activity. Another sign of stress is more easily seen in a measure called it's private domestic sale or domestic sales to private domestic purchasers. This basically strips out those swings from inventories and trades and looks at underlying demand in the economy. That slowed notably in Q1, slipping below 2%. What drove that deceleration was a pullback in consumer spending. So consumer spending grew at a very slow pace, only 0.5 percentage point in the first quarter. And that's largely driven by those tariff threats, increasing economic concern among consumers and causing them to be a little bit more cautious. So where are we at now in the tariff landscape? I was just looking at, the Wall Street Journal and saw there was more tariff updates that I didn't see. It's a constantly ever-changing policy position. Current policy has the effective tariff rate at 16% in the United States. Before this year, we were at less than 3%. So that's a significant upshift. Now, there were more tariffs announced that are slated to go into effect in early August. If those would go into effect, it would bring the tariff rate up to 24%. Even more uncertainty is prevalent, though, because a large portion of these tariffs are currently undergoing court challenges. That'll take a while to work itself through the court system, but if the tariffs are ultimately ruled to be illegal and they were to be taken away, it would bring the tariff rate down to 7%. Still above, 3, but significantly lower than we are now. The point of this chart is that tariffs are elevated far above recent norms, and there's a heck of a lot of uncertainty still hanging out there. So a lot of people ask me, tariffs aren't showing up in inflation yet, so the effects must not be that bad, right? And my response to that is they haven't shown up because of the import build, the inventory build that occurred in Q1. So this chart shows just imports of consumer goods spiked to the highest level on record in the first quarter and then fell right back down. So it was a temporary surge. Businesses are still tapping those inventories, those pre-tariff inventories in their operations. They will run out though, and will have to be replenished. And at that point, tariffs will make a more meaningful mark on consumer prices. So if you guys were, you might have seen a headline about the Consumer Price Index, which came out yesterday, 2 days ago, this week. And there was a little bump. So year over year, CPI did rise to 2.7%. But anything with a 2 handle is still okay, right? The thing is, if you parse through the underlying details of that report, you see more clear tariff effects that are already starting to show. The chart on the right shows, for example, CPI specifically for furniture, which accelerated to nearly a 3% rate in June. Another thing I like to look at is surveys of businesses. So there's something called the ISM indices of both manufacturing and services. And just based on these qualitative reports from businesses, there's a rising share reporting having to pay higher costs for their inputs. So what does this mean for our forecast? This chart shows a different measure, not CPI, but something called the PCE deflator. The Fed pays attention more to the PCE deflator in making its monetary policy decisions. And it breaks up what's driving the headline movements in PCE. The bottom two bars are services. Services inflation remains elevated over what it was before the pandemic, but is on a downward path, slow but steady deceleration. The red bars are goods prices. Goods prices they were falling for quite a few months as supply chains righted themselves and we got through the global supply chain crisis that inflated prices. They've recently turned positive again, and we expect them to increase even more over the coming months, driven by tariff pressure. So that's what we're expecting to lift overall inflation over the coming year. We forecast that this core PCE deflator will peak to about 3.1% in the fourth quarter on average, and then can proceed to slowly come back down. Tariffs are a one-time increase in prices. It's not an ongoing push in inflation rates. So theoretically, it should be a temporary shock. Now, let's move on to other parts of the economy. Just how are things holding up so far? The jobs market is kind of the first indicator into whether we're entering a period of recession or stagnation, so it's an important thing to pay attention to. The U.S. economy added over 140,000 jobs on net in June. That was far exceeding expectations. I believe expectations were close to 100,000. I know we had expected 100,000. So on the surface, everything's fine. We're doing well. But if you look at what's driving those jobs, in June, it was entirely driven by three industries. Government and healthcare. Those are not cyclically sensitive, not really responsive to interest rate changes or economic headwinds, more tied to population growth. And then leisure and hospitality, important to Florida, and still catching up from the pandemic downturn. Other sectors like finance, real estate, technology, those interest rate sensitive sectors largely lost jobs. So they remain under pressure. So I just, kind of outlined the negative economic effects of tariffs, but we're all two-handed economists, right? Not everything is one way or another. Tariffs do bring in revenue for the federal government, which is desperately needed at this point in time. Estimates suggest that the tariffs could bring in, $280 billion per year. And that is, I believe, 4 times higher than the run rate we've seen over the past few years. For context, our overall deficit is $2 trillion. So although it would help to raise revenue, it is not enough to close the gap. So you might have seen Congress recently pass this reconciliation bill, right? The One Big Beautiful Bill Act, I believe it's called. And we ran an analysis on what the effects might be from a budgetary standpoint. The bill in itself is debt raising. But if you include the tariff revenue in the calculation, it's more or less deficit neutral over the long term. So our forecast for the federal budget balance is a little bit, choppy. In the near term, the bill would be a net positive, and in the longer term, it would be a net negative. But through the swings, it is more or less neutral. So what does this all mean for interest rates? The Fed raised rates at the fastest pace since the early 1980s. That was when in March of 2022, when the Fed admits they were a little bit late, they responded to high and rising inflation. They had to play catch up. They proceeded to cut this federal funds rate by a full percentage point last fall. But they haven't made any changes since. So we've hung out at 4.5% since for this year. Looking ahead, yes, communication has been hawkish, but it's starting to change. Basically, we think that an economic slowdown, specifically an increase in unemployment, prompted by this increased tariff burden in the second half of the year, will be enough to spur additional interest rate cuts. So our forecast at the present moment is for 3 rate cuts in September, October, and December, 25 basis points each. I believe the market is pricing 50, although I haven't looked in a few days, so that might have changed. So we're a little bit ahead of what the market expects. Generally speaking, though, I think risks are tilted toward higher interest rates than that. There's a whole other added layer of uncertainty with the shakeup on the Federal Reserve's board and chairmanship. All of that's coming next year, and that could have implications. But as of right now, we think that the Fed will cut rates, we say 3 times, and then hold them steady as inflation remains elevated. Now, our forecast for GDP growth or economic growth follows these trends that I've outlined. We expect GDP growth to downshift in the second half of the year, caused by higher business costs and consumer costs from tariffs. But then after that shock fades and as the tax cuts stimulate economic activity, which we think is more of a 2026 story, we do see scope for improvement in economic momentum next year. So now I'm going to move on to talk about the Florida economy. And I'll start by saying the Florida economy is very resilient, and it's set itself apart from the rest of, or other states at least. So this chart looks at just economic growth on an annual basis, contrasting Florida with the U.S. Average. Based on data that we have, which goes back to 1998, Florida has generally outpaced the nation from an economic growth perspective. That wasn't true during the housing bust because Florida is a very real estate intensive economy, and so it was disproportionately affected. But since then, the state has been resilient in the face of those high and rising inflation rates and interest rates and other macroeconomic challenges. I'll note here, so this shows through 2024, in Q1 of 2025, when U.S. economic growth contracted by 0.5%, Florida's economy grew at 1.4%. And Florida was only one of a handful of states to post positive GDP growth. So this strong economic momentum has helped to sustain the labor market. So the chart on the left shows that Florida added payrolls at a 1.5% growth rate over the past 12 months. That's through May. That outshines the 1.1% rate from nationally speaking. So job growth has downshifted. Things have slowed from the post-pandemic fervor, but still continues to be strong from a labor market perspective. Now, we get new data tomorrow, so I have to couch that. Things can always change. But as of right now, through May, Florida's economy is adding jobs basically at the rate from a monthly basis that we were before the pandemic in 2019. So added 20,000 or so jobs in May. This chart, I know it's a little bit hard to see. I love bubble charts when talking about states because you literally just lay all the states out there and see how they stack up against each other. What we're looking at is job growth. The x-axis shows the year-over-year percent change, and the y-axis shows quarterly percent change. So how is Florida doing relative to a year ago, and how is Florida doing over the past quarter? I highlighted it in yellow, which is kind of hard to see, but Florida's at the very tippy top of this chart. Yes, some states like South Carolina, which are very strong right now, are outpacing Florida, but generally speaking, from a job growth perspective, Florida ranks as one of the strongest economies in the country. Another thing that I was so excited to see is industry job growth. So this is the same chart, but at the industry level. Year-over-year percent change on the bottom, 3-month annual or quarterly percent change on the y-axis. Every industry is growing by both metrics, both on an annual basis and on a quarterly basis. I'm working on a report about the California economy, and let me just say it does not look like this. So that's just shows the economy-wide resilience, industry-wide resilience for the state. Education and healthcare, mainly healthcare, is a large driver, which is true nationwide. However, Florida has recently seen an acceleration in information, technology payrolls, also professional and business services. That includes some technology and professional consulting, scientific research, things like that. So this strong labor demand has implications for wage growth. This chart plots annual growth in average hourly earnings, showing the trend in Florida versus the nationwide average. It's pretty clear here that Florida's wages are growing much faster than the nationwide average, both from a trend perspective and just an overall perspective. Wage growth did dip at the end of last year, but if you look through the volatility, the trend is still rising. The state also has a lower unemployment rate than the nation, which has remained the case in the post-pandemic period. I will say that this is kind of a two-pronged result, though. So A, you have strong labor demand, but B, the demographic challenges facing the state seem to be weighing on labor supply. So the chart on the right specifically plots labor force participation rates, which have declined quite substantially in the state of Florida, tied directly to demographic issues. Zooming in on the labor force, which I love to do because you can't have a strong and growing labor market unless you have a strong and growing supply of labor. We've seen that labor force growth has slowed down quite significantly in the state this year. Less than 0.5 percentage point increase over the past 12 months. The chart on the right plots the monthly changes. There's some volatility with this because the Census Bureau made some methodological updates based on population growth that inflated the January number. But kind of past January and through the volatility, the pace of labor force expansion has notably slowed in the state. This data is subject to revisions, though, so that's one thing I will say. It makes my job hard because last year when I was looking at Florida's labor force growth, it had already turned negative, and then the revisions to population growth wiped those negatives away. So there's a possibility that this could overstate the weakness in Florida's labor supply, but I think the demographic challenges of an aging population are apt to suppress growth in labor supply. Population growth has been Florida's silver bullet. It's what has kept demand in the economy afloat, and it's what has kept labor in the economy afloat. Businesses choose to relocate here, not only because of the tax and regulatory environment, but because of strong population growth setting the stage for a flow of workers over the coming years. In 2024, Florida was behind only Washington, D.C. in terms of annual population growth. So technically the fastest growing state in the country if you don't count D.C. The chart on the left breaks down what has driven those population gains. The red bars are immigration, international migrants. The blue bars are domestic migrants, someone who moves from another state into Florida. And then the purple is your natural population increase, the number of births minus the number of deaths. You can see that in the post-pandemic period, an influx of immigration has really lifted Florida's population growth. I'll say that's true around the country. It's the story nearly everywhere that population growth post-pandemic has increased due to the entrance of new international residents. So that's been a good thing for Florida, keeping its population growth strong, lifting it to the strongest pace in the nation. But if you zoom in on the blue bars for a second, as international migration has increased, domestic migration has actually softened. So in 2024, the number of people who moved to Florida from elsewhere in the U.S. dropped to its lowest level since 2009. I could speculate as to why. There's high home prices, likely discouraging new entrants. There's things like natural disasters. So my parents' home was destroyed by Helene, and they had to leave the state. So some of that could be going on. Generally speaking, I think affordability dynamics as the post-pandemic period kind of spurred a ramp up in population growth that led to an increase in prices. So I think affordability issues are probably discouraging new movers to the state. On the chart on the right, I broke down population growth by metro area. So Orlando was a big one that stood out to me, a large metro that grew at a fast rate. You also have a place like Ocala or Lakeland that is generally growing very fast. Do I have Tallahassee in here? I thought I did. Maybe I don't. Sorry, guys. That was an oversight on my part. And I don't know it off the top of my head, but I can look it up and get back to you. Then you have Tampa, where population growth has notably downshifted. And same thing, Naples, West Palm, that's where prices are sky high. So there is some variation across different metros, but each of these metros are growing at a very strong rate. So this chart maps home price growth. The darker states are places where home prices are growing at the fastest rate on an annual basis, and then the lighter states have the softest rates of home price appreciation. What sticks out to me first is that this map has grown considerably softer every month of this year. So every time that I show this, the map has gotten lighter and lighter and lighter. Nationwide, we're seeing a slowdown in price appreciation in the housing market, and that's because affordability challenges are reigning supreme and really suppressing home sales. Florida's home prices are actually declining on a year-over-year basis. That's the second month that this was the case. You have Texas prices declining, DC prices declining, Hawaii. Those are the only 4 places where home prices are down year over year. Now, on one hand, that's good because that could help assuage some of the affordability issues. On the other hand, it's leading to a big increase in home supply. It's bad for builders or homeowners looking to sell their home. This is a product of not only high prices and high mortgage rates, but also high home insurance costs and, providers leaving the state or reducing their coverage. So Florida is facing a fair amount of housing market challenges. If you look at kind of metro-based where home prices are moving, we do see that Miami is its own thing. Miami housing market is holding up and is stronger from a price perspective. But Orlando, Tampa, Jacksonville, prices in each of these cities have softened quite considerably. Negative in Tampa, for instance. So I mentioned that this is bad for builders. Builders generally are cautious about the trajectory of new home demand this year. We see builder confidence has kind of tanked. Expectations for sales has weakened quite a bit. And they are responding to the fact that over the past few years, there's been this big ramp up in new home building. I'm sure you guys see it everywhere. I certainly see it in Charlotte, both apartments and single family homes. And now that these housing market challenges are being sustained and we still have mortgage rates near 7%, that increase in supply is a negative from a home builder standpoint. So we do expect single-family building to soften this year. If you look at the trend so far, which is the blue line, we have seen a decline in single-family building permits. Alternatively, all of these housing market challenges are actually a tailwind for the apartment market. So it used to be that your mortgage was about 30% of your income. Now it's close to 50%. And because of that, the median price of an apartment rent is below the median price of a house payment. That wasn't true for a very long time. So it is pushing people to rent for longer. That's bolstering the apartment market and increasing apartment construction. Now, different markets are different. Florida has seen one of the largest increases in apartment construction in the country, but it seems to be increasing despite that fact. So it seems to be that Florida's housing market challenges are bolstering apartment demand enough to spur further increases in apartment building. Now, another, sector important to the state is tourism. I'm from Tarpon Springs. That's a very tourist-heavy town. A lot of people come to eat the Greek food, which I highly recommend. What we're seeing is that there seems to be a lower aptitude to spend on discretionary services in recent months, really since the start of this year. And that includes travel. It includes spending on hotels. This chart shows that real inflation-adjusted discretionary spending on services has declined on a year-over-year basis. That never happens outside of recessions. So consumers are growing cautious. They read the headlines, they see what's happening, and they're maybe changing their travel plans or deciding to wait or just not being so apt to go out and travel at the current moment. You can't talk about the travel industry without talking about the dollar. So the dollar's been volatile. It's tied to a bunch of different stuff, but generally speaking, we do think that the dollar will soften if the Fed cuts rates like we expect. But we don't think the dollar is going to lose its reserve currency status. I see a lot of talk about that, about do you think people are still going to have an appetite to buy U.S. Treasury bonds? We think the dollar is going to remain supreme from a currency standpoint. So even as we expect some depreciation this year, we do think that a ramp up in economic activity next year will inspire the dollar to appreciate again. So that's actually all I have. I'm happy to answer any questions that you would want to pick my brain about.
There's a microphone over here. Right here.
Just a little clarification. I always thought tariffs would just impact the consumer, but you're talking about how it creates the revenue for the government. Help me understand that.
So a tariff is a tax on an import. It is paid by the entity that imports the good. Over half of imports are actually intermediate or capital goods, industrial supplies, things purchased by U.S. companies for their operations. Both services companies and goods producing companies use foreign-made goods in their processes. So that's why it affects prices along the supply chain. It also raises revenue for the government because the government is taxing the importer and taking that money as revenue. So it does both.
Thank you for your comments today. I have two questions. Number one is a macro question. You talked about the dollar being in pretty good shape. It's softening some. There has been an effort by some of the other countries that are dictatorial, China, Russia, to create a counterbalance to the dollar. So I'd love to hear what you think is the potential of that having any real impact. And then number two, do you think that the interest rates that are being charged right now is the right place to be? And then actually I want to ask a third question if I can. And that is that as the Fed drops the interest rate, what's the counterbalance for the inflation? So, for example, if they drop it by a quarter of a point or a half a point, or you indicated maybe 3/4 of a point over this year, then that's going to build up demand for housing because people will be able to afford the homes and stuff. So, how does that work? Thank you.
Okay, but before you leave, just remind me again, it was the question on other currencies, the question on interest rate cuts bolstering demand, and then what was the other one?
I have no idea.
Does anyone? Oh, okay. Okay, so other currencies rivaling the dollar. So there's things like BRICS, the BRICS nation, or even, the euro are these potential alternatives to the dollar. We don't think so. U.S. Treasuries, the market is the deepest and most liquid market in the world. If you were to try to do it with something like a euro, it wouldn't be contingent on one country's economic performance. It would be contingent on a bunch of countries' economic performances. So that would complicate matters further. Generally speaking, demand for treasuries there's been a little bit of scares here and there about whether treasuries are behaving as the safe haven asset that they've been historically. But signs still do point to investors seeking safety in treasuries. So we don't think other currencies will rival the dollar. Are interest rates at the correct level right now? There's no correct level. That's the hard part about economics. There are things you could do to target monetary policy based on formulas. So there's something called NGDP targeting that's been talked about. The way the current Fed operates is very much judgmental, subjective, and it's based on lag data that is subject to revisions. So what would have happened if the Fed, have we all received the correct jobs market information on the first go instead of the revisions that prove that job growth in 2024 was some 800,000 lower than originally reported? What would have happened? Probably something. Something would be different than it is today. But unfortunately, we don't have that luxury. So my only conviction is that interest rates I'm not even going to say that. Interest rates will stay at a higher level than in the post-Great Recession period because inflation and productivity growth, these things necessitate a higher level of neutral interest rate. Sorry, what was the other one?
The third question was, as you drop the interest rates, impact on inflation.
Okay, so you specifically mentioned the housing market. We do have interest rate, the federal funds rate, declining by 0.75 points this year. But the mortgage rates are not only dependent on a federal funds rate. So inflation affects mortgage rates, which we expect to increase. A ton of other economic factors go into mortgage rates. So we only have mortgage rates dipping to about 6.5%. Not very much. So yes, lower interest rates are intended to stimulate economic activity and ideally labor demand, but we think that tariffs are going to be a driver of inflation, not necessarily lower interest rates. Mm-hmm.
In 2016, the Fed said that the tax cuts were inflationary. And if tariffs are a tax, shouldn't the effect of tariffs on the inflation rate be backed out of the inflation rate? Taxes are either inflationary or deflationary.
Should they be backed out of the inflation rate? So the thing is, the tariff itself is not what raises the price. It's the fact that businesses will increase their prices to afford the tariffs. So I've had dinners with, for example, builders that say their margins are under 10%. So they physically cannot absorb the tariffs that they're facing now. That makes them increase the cost of the homes, right? So generally speaking, tariffs are partly absorbed by the importer, partly passed on to consumers. That's what makes them inflationary. Does that make sense? Yes, it is a tax, and like I showed, it can be estimated to raise about $280 billion per year.
In 8 months, the Federal Reserve will change chairmans. What policies do you expect to take place at that time? Policy changes.
It's very difficult to predict the future. So I do not know. A lot can happen between now and then. I guess the fear is that the change in leadership will prompt a reduction in confidence in the independence of the Federal Reserve. And that has implications for Treasury yields, for demand for Treasury bonds. Even yesterday, yields briefly blew out when reports landed that the president was planning on firing Jerome Powell. So that's the worst case scenario, that inflation expectations would become unanchored, or that appetite for U.S. debt would decline because of a reduction in confidence. Obviously, that would reduce the value of the dollar. But who knows what's going to happen? So we're just waiting to see.
For several years, I've been hearing economists like yourself speak about the demographic trends and labor force declining, causing payroll rates to increase and therefore add inflationary pressure. That seems borne out by some of the Florida numbers that you showed, Florida having higher payroll cost increases with a declining labor force. How are changes to immigration likely to affect that? Not this year or next year, but over the next decade?
Sure. So the theory and the trends are that a reduction in labor supply increases the cost of labor, which then could increase the cost of consumer goods, or certainly increases the cost of production. How the United States as a whole faces mounting demographic challenges, not just Florida. The CBO, the Congressional Budget Office, actually projects that natural population growth will turn negative in under 10 years. So if that were to happen, unless we have an offset from immigration flows, that would reduce the supply of labor, certainly cause it to go slower, and put this upward pressure on inflation. That's actually another reason why I'm convicted that interest rates are going to stay higher than they have been, because demographic forces are leading to a higher inflation rate. Who knows what's going to happen 10 years from now? You know, you see these projections over the next 10 years. Even when the government does it, it's very hard to project anything in the next 10 years. But if current trends hold, a reduction in population growth is an economic drag, not only on Florida, but on the country as a whole.
Hey, great presentation.
Thank you.
I noticed earlier in your slides you had the effective tariff rate over time, and the previous spike was in 1936, where things were great until they weren't. So I was wondering if you could comment on kind of the macro effects of tariffs throughout economic history, and kind of how much they play a part in major factors in the economy.
Anyone seen Ferris Bueller? You know. I think it's pretty much economic consensus, although that's changing a little bit, that tariffs are a drag on the economy. We've seen it play out in history before. It depends on the magnitude of the tariff rate. It depends on the uncertainty they cause. But generally speaking, any added costs, whether taxes or tariffs, are going to slow economic activity.
In the Florida slides, and I think it was slide 7, you showed that education and healthcare was the strongest industry in terms of employment growth. Mm-hmm. Do you have the breakout between education and healthcare?
It's mostly healthcare.
Yeah.
It's mostly healthcare.
Is education declining, or do you know?
It wasn't declining, but the rate at which education and healthcare is growing is driven by strong growth in the healthcare sector. Thank you.
You've been listening to Jackie Benson, Vice President and Economist with Wells Fargo's Corporate and Investment Bank, speaking before the Economic Club of Florida on July 17, 2025 in Tallahassee, Florida. For more information on Wells Fargo, visit wellsfargo.com. The Economic Club of Florida promotes interest and enlightenment on important economic, political, and social issues of the day. To learn more, including how to become a member, visit our website at economic-club.com. This program was recorded at the Florida State University Alumni Center in Tallahassee, Florida.